So long term, yeah, the fundamentals are still good. But listen, we all know tax cuts, repatriation of money, 700 plus regs cut. The backdrop is still pretty good. But I think if there's going to be a decline the rest of the year, it starts in the next 1, 2, 3 weeks. It's a mid to high single digit. I don't think it hits 10%. I think it's, people call it a tactical pullback. Stocks have come pretty far since the Q1 lows. And now you're seeing a split market. People have talked about it before. You've got a lot of stocks doing really well, and you have a lot of stocks even in bear markets now. So I think the window of opportunity, as I call it, is open now for a routine, normal, healthy pullback on the way to Dow, possibly 30,000 by July 4th.
By July 4th, because you say we got to get to 27,000, obviously, to get to 30,000. But once we get there, then that's your target now, and then you'd raise your target on the Dow to 30,000.
And as our targets go, it takes five closes above a number, and the next target gets open. So 5 closes above Dow 27,000 will open the door to Dow 30,000 by July 4th. Yeah.
I can tell you that a 8, 9, 10% correction, if it were to come, as you say, in the next couple of weeks, it would be tied to China and tariffs, and I think it would coincide with the midterms coming up. So there'd be all kinds of conjecture and commentary and rhetoric that would be attributed to tariffs and politics, I think, and the midterm.
I think it's always hard in advance to assign blame or credit.
I'm not saying that it's real, but that's what you're going to read, because people have no idea why things are happening.
And if you lean to the right, you have to be concerned. If there is weakness ahead of the election, that certainly has favorable conditions for the Dems to take the House, which I think they will by 5 seats. If the Dems take the House and the Republicans maintain or gain seats in the Senate, I don't think the market cares at all. And even if the Dems sweep, which I don't think happens, I think it's a really short-term story, because the backdrop is still good. You still have a Republican in the White House. So maybe the agenda ends, but infrastructure gets done next year. And still, I think you've got higher prices coming in the markets.
A lot of cross currents. I think, Nate Silver, I think we're at 25% that the GOP holds on, 75 that the Senate holds on for GOP. And then you had a recent NBC Wall Street Journal poll shows up 11 for generic Democrats, or 12, might have been 12. But then you had the overall GOP approval rating on a Gallup poll at the highest level in 7 years, higher than, and GOP is more favorable than Dems. But that was after the hearings, but before the accusations. So it was. I'm not sure that initially the Dems comported themselves.
Look, I think we're still a month away. I think so much is going to happen. I think so much is going to happen maybe on Thursday, and who knows what's going to happen.
Look, we got Rosenstein and Dr. Ford on, and Brett Kavanaugh.
But the average voter, you poll them now, it's one thing. They're in the congressional districts. They're really voting for that person. It's not like
all politics are local. You're right, and they're
so
and they're
it's
local,
much more localized than the every 4-year presidential elections, and they don't vote with their wallet as much as they would if this was 2020.
Right.
But people obviously still care about the economy.
All right, let's get to Matt.
The only dots that matter on the dot plot are really the terminal rates, right? So they're at 2 7/8. There's really very little debate that the Fed will get to neutral. The debate is, will they go beyond neutral? The bond market is saying no, that they'll stop at 2 3/4 to 3, and the Fed is saying they might. So we think that the Fed will not take away optionality tomorrow. The next 3 are baked in the cake. The question is beyond the next 3.
Do we have normal asset allocations, even though everyone's expecting rates to go higher? Do you like high yield or something? Or what do I use for my portfolio for the fixed income side of things? Munis? I mean, what are you telling people?
Right. So munis are attractive, particularly in high tax districts, which have a higher incentive to own them. Still, there's a bias towards instruments that will benefit from an upward lift in rates through the end of 2018 is our key call. Once you get into 2019, you're talking about the last couple Fed hikes, the 10-year Treasury likely to be capped out at 3.5%. So still a bias towards floating rate instruments, lower duration instruments. But next year, look to potentially extend duration in the second half of 2019 as the ECB begins to do some of the lifting for the Fed.
In general, with high yields or corporates, things like that, do you worry about interest rate risk because we are in a rising rate environment, Or has it become dicier when in an economic slowdown because of credit risk? Or I guess you always have to take both into account.
Yeah, it's always both, Joe. You're right. But today it's more interest rate risk. Default rates are still projected to be in the mid 2% ranges. You have seen a degradation in covenants across senior bank loans and high yield, but that doesn't create credit risk. It actually creates casualty and default risk, which is the downside of the next economic cycle, not today's worry. That's more of a worry in 2020 and beyond. So the corporate outlook is still decent. As Paul mentioned, earnings are decent. You can have chop, but that income from corporates is still quite valuable in today's environment.